Welcome back from lunch. I think we have the most difficult job after lunch when everybody's feeling a little sleepy to keep you all entertained, but we'll do our best. First of all, let me congratulate the organizers of this really timely and consequential event. It's been a rich discussion that we had this morning. We continued it in our small groups over lunch, and we at the IIF are very grateful to have the chance to participate today. So we have a fascinating topic for this session. As you were just saying, empowering productive and inclusive finance. You might have called this a lot of different things over the years, industrial revolution or digitalization, net zero transition, but empowering has always been at the core of what we do in the financial sector. We empower growth. We empower jobs. We enable capital to flow from where it is with savers and investors to where it needs to be to support households, commercial businesses, governments, and trade all around the world. But as we know, international financial market conditions are dynamic. They change all the time. And I think that's been especially true in recent years. For example, if you look at measures of global policy and economic uncertainty, they are at record highs. You can see here that's the blue line on this screen, and the other is the gold price. So those two kind of go together. People feel uncertain. They think, okay, what can I rely on? I can rely on gold. Another record high can be seen in levels of global debt, which is something that we monitor closely at the IIF, and that certainly adds to concerns about market risk. So much about the world has been changing. We heard a lot about that this morning. The rising geopolitical strains, a less multilateral world, trade tensions, new technology. All of this affects how capital flows across borders and how well financial intermediation can help drive growth. And that is, of course, a key function of the financial sector. So many things the financial sector does, but market making, intermediation are a big part of it. At the moment, all of this policy uncertainty, and if you throw in energy security concerns, inflation, tariffs, supply chain disruptions, that's led to a generalized rise in risk premia, and this can clearly be seen in higher U.S. long-term interest rates, and that affects borrowing costs around the world. However, we do not believe that globalization is ending. And rather, as my CEO said this morning, the global economy is being rewired toward more localized regional business models with a really strong focus on resilience. Companies are shifting away from very intricate, complicated, just-in-time networks to something more suitable for our times, buffer-based, local, near-shored, and friend-shored supply chains. Corporate performance is increasingly being judged by how robust and resilient it is rather than just marginal efficiency or how much revenue it raises. So a lot to be said for this friend-shoring conversation. It's really quite an interesting development. And of course, you see Korea is here in the slide. So how do we make finance more productive and inclusive? I think it's fair to argue that financing energy security is key. And that's also, of course, essential for the energy transition. You know, you had mentioned sustainable finance. Energy security is at the heart of national security, of economic growth and innovation, including in the digital economy. You've got to have energy security. And with geopolitical strains on the rise, the need for energy security has been driving countries to bolster their strategic autonomy, strengthen their defense capacity, and enhance industrial competitiveness. For example, Europe's pivot from dependence on Russian fuels to natural gas and other new sources of supply, it really highlights the need for agility in crisis response. This slide here just shows you what a ramp up in global defense spending there is anticipated to be. The end of this slide is 2050. So that's just really expected to continue. A big demand on government resources. But these kind of strategic shifts can only happen if the right infrastructure is in place, physical and digital infrastructure. And of course, you've got to have the fiscal capacity, And that brings us back to the role of the financial sector, from providing liquidity in government bond markets to underwriting catastrophe insurance, long-term project finance, venture capital. Financial intermediation is fundamental. And the need for energy is skyrocketing. Electricity demand is on the rise. The energy demand here is the black line that's going up rapidly, and the end of the graph is 2045. So huge surge in energy and electricity demand projected. Also the rapid expansion of digital infrastructure, so including all of these data centers. This is straining our electrical grids and pushing up prices. So we need to scale up investment in electricity generation and transmission. We need to make things happen more efficiently and implement things like flexible load management practices. The other thing is, as infrastructure around the world ages, even in wealthy countries, I mean, you know, in the US, as my US colleagues can attest, our infrastructure is in really bad shape in many cases. This exacerbates the risk of hazards like blackouts and cyber threats with potentially disruptive impacts on the economy and on social cohesion. All this is quite dangerous. The need for energy security puts global trade tension in the spotlight. So as we've been hearing today, tariffs, industrial policy is already raising the cost of clean energy technology and creating risk around critical minerals like lithium and copper. This is especially true for the poorest and most vulnerable economies. And moreover, the use of tariffs in industrial policy, particularly by the United States, is also affecting the global push to scale climate and sustainable finance. For the financial sector to support global climate and development goals, we need an enabling policy and regulatory environment. And increasingly, we are seeing policy, climate policy, development policy, regulatory policy diverge around the world as countries take different directions. For example, here in Asia, many countries have robust, practical transition plans and active green bond frameworks. We see a lot of emphasis on financing resilient infrastructure. A lot of governments, including the government of Korea, have incentives for investing in decarbonation, which are very much needed. In Europe, too, the green agenda is alive and well, maybe a little bit more pragmatic on the regulatory front after all of the deregulatory efforts by President Trump. But in a recent speech, European Commission President Ursula von der Leyen highlighted EU policy priorities. So yes, competitiveness, yes, defense and security, but closely followed by social equity, climate, and digital fairness. Certainly that focus on inclusive finance is very clear, at least in the EU. But when you factor in the US ESG backlash, what you have is a lot of policy and regulatory fragmentation. So it makes it even more challenging to channel cross-border flows, either whether that's financial flows or trade flows. But, and I want to emphasize this, despite these challenges, governments around the world are still eager to pursue what you might call green comparative advantage. You could call it a green arms race, if you will, through trade and market channels as part of their long-term growth strategies. These strategies can be especially helpful for developing economies with rich natural resources. So the drive to secure critical transition minerals is set to accelerate as countries pursue clean technology in a race to win markets and gain geopolitical advantage. Indeed, annual clean energy spending has surged to something like $2.2 trillion per year, although 75% of that is in advanced economies in China and only about 15% in the whole rest of the world. To truly make finance inclusive and to meet rapidly growing demand for energy, more transition capital has to flow to these developing economies. On the other hand, investment in fossil fuels has to continue, of course, for practical and political reasons. Fossil fuel investment is now running at around $1 trillion per year, which is less than half of the annual clean energy spending. Looking ahead, analysts expect fossil fuel investment to decline as demand continues to weaken in some key economies, including China. Bottom line is that the cost of new technology still needs to come down relative to the cost of fossil fuels. But the good news is, here in Asia at least, the rapid build-out of export-oriented production capacity, especially for renewable energy and electric vehicles, is really helping to bring down these costs. So you could just look at the work of major Korean automakers in building new EV plants and expanding their range of models. This is also a good example of how government policies can help, such as initiatives and incentives to build a strong battery industry. Really important. The last topic I want to focus on today is, I think, the cornerstone of transformation as we move beyond industrial transformation, and that's finding a way to finance resilient global growth. This is a complex subject, but the key is to make sure that social, political, market, and technology factors all work in alignment. So two of the key factors that we need to address are, number one, broadening access to finance. If you're going to build a sound foundation for resilient, inclusive, productive growth, we have to ensure affordable banking access for households. In many countries, people are facing high inflation, even a cost of living crisis. Small businesses, we were talking about this last night at our table, small and medium-sized enterprises in many parts of the world are finding it much harder to access financing. And the growing use of tariffs internationally, as we've been saying, means that these costs of tariffs are being passed on to the consumer and to small businesses. We need to mitigate these costs even in wealthy economies. There's just a growing divide between rich and poor. So measures of inequality, all my economist friends will know about Gini coefficients. Those are on the rise. Financial inclusion can help. And this is really a space where digital finance technologies and solutions can make a big difference. Another challenge, I think, in addition to financial inclusion, is to ensure resilience that works with global regulatory standards. With so much economic and policy uncertainty, regulators are increasingly focused on financial system resilience and robustness in the face of shocks. And I think we're going to hear more about this in our next session today. But despite efforts to implement strong prudential frameworks and supervisory mechanisms, microprudential risks continue to appear. For example, banking sector prospects around the world are certainly affected by these record global debt levels, which affects the creditworthiness of all asset classes. They're affected by trade tensions and by things like cybersecurity risk. So regulators are acutely aware of all of this. And in a world where multilateral coordination is harder to achieve, keeping to a standards-based international financial regulatory architecture is critical. The regulatory framework, of course, needs to ensure soundness and stability. Of course we do. But it also needs to enable appropriate risk-taking. And make no mistake, providing productive, inclusive finance requires risk-taking too. Let me illustrate sustainability-related disclosures. These have been in the spotlight, but you've got to have proactive engagement between standard setters and the private sector to support cross-border comparability in this type of disclosure to make it useful for investors. After all, lenders, investors, insurers, asset managers can't properly make investment decisions without clear, comparable corporate disclosures around ESG risks and opportunities. And that brings me to my final point, the role of the financial sector in supporting global growth and managing climate physical risk. Despite differences in climate policy around the world, it's clear that managing climate risk and transitioning to a low carbon or net zero global economy is essential for productivity and long-term growth. Science has always told us net zero transition will not be easy. Political change in recent years tells us that some economies are going to move faster, some slower. And that in turn means that internationally active financial firms are going to be subject to different rules in different jurisdictions. So making international alignment is much, much more difficult. So let me just end by saying that some of the keys to unlocking productive and inclusive finance can be found in infrastructure investment. The scale of investment needed for smart, climate-resilient infrastructure is massive, making multi-stakeholder collaboration between corporates, finance, philanthropy, and government ever more critical. So thank you very much for your attention. This is a fantastic conference. I look forward to the rest of the discussion.